Hello, fellow investors. Welcome back to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, we're going to dig into some really important topics related to some things that are potentially changing in the investment world. Relate some things in front of Congress related to who can invest, what you can invest with, kind of how you can do those things. And so I think these are very relevant today in our world of who and how you can invest. I thought it was great to have someone who's been on the show before, Gene Trowbridge, come on and really give us an update on kind of where these things are and kind of how they might affect, your ability to invest in alternatives, including real estate. So Gene, thank you so much for coming on the show today.
Well, sounds good, Ken. Thanks for having me back. As you know, maybe your audience, some of them are new, is I'm a securities attorney, and I was a syndicator for 20 years. And then at 45, I went to law school to become a securities attorney. And so this is the only type of law I practice, putting together groups of investors to buy stuff. It isn't always real estate. Last year, we did a stable of racehorses. We did a professional hockey team. We did fiber optics company. We did a metal plating company. So there are all sorts of places where the person who's running the business needs money from other people. And that's why you become a syndicator. You find something you want to do, and you either don't have the money to do it yourself, or if you do, you don't want to put all your money in it because then you won't have any left and maybe it's too risky. So you want to take the opportunities that you find to other investors that you know. So that's where we are. And as far as the investors go, the investors are always looking for good sponsors and looking for good opportunities. But there are a couple of things going on in the securities side, the SEC side of this that I can talk about. And nothing is finalized. We're all just hearing what the SEC is talking about. And Kent, there's always the battle: capital formation, investor protection. The SEC wants capital formation. How can we get people to put money into businesses that hire people? And number two, how do we protect the investors in those cases? And the biggest thing we have is that in 1980, when I was syndicating, something came out called Regulation D. And Regulation D changed the whole world, and that's how we're working now. 1980 gave us a definition of what is an accredited investor. It gave us the difference between accredited and non-accredited, and gave you a way to go out and try to raise money. So the first thing the government said is, yes, we want everyone to be able to raise money. We want a capital formation, but some people can fend for themselves and some people can't. And as the government goes, they have a vested interest in protecting those who can't. So who are the people that they said can invest on their own and can handle it themselves? Well, accredited investors. 1980, an accredited investor was defined as someone who had $1 million of equity or made $200,000 or $300,000 a year, whether they were single or married. We never had that definition before that. The only reason I'm going through that is when Reg D came out in 1980, only 3% of the households in the United States were accredited. So they thought that they had a good protection for all the other people who can't fend for themselves. Well, now with everything that's going on, appreciation of assets, increase in revenue, the SEC thinks that between 18 and 20% of the households in the United States qualify as accredited. That gives them some heartburn. Do we really have 18% of the households out there who can fend for themselves? And so that's a challenge. The first thing they did actually back in 2008, Dodd-Frank came along and said, when you calculate your $1 million net worth, you cannot include the equity in your primary residence. We took that off the table in order to protect the investors. But it really didn't take the percentage of households. At that time, I think it took it down to about 15%. But now we're back up to 18%. And the government's concerned. One of the things that the government is throwing out, once again, this hasn't been settled, but this is in the conversation, is that the money you've saved up for retirement in a IRA or 401k or wherever your retirement money is, that money can't count toward the $1 million definition of your net worth. First of all, they protected everyone against losing the equity in their house. Now they're thinking, shouldn't we protect people from losing the equity in their retirement accounts? And that isn't statute yet, but there's a lot of conversation about that. What do you think? What do you think about that?
I mean, it's interesting. I don't know that, I mean, I guess it would change the hurdle for who can invest, but I mean, right now you can't invest with your 401k actual dollars.
Not yet, but we'll get to that because you and I
Well,
know
well,
that
okay, we'll get to that. So, because I was going to say, well, the 401k dollars are still protected because you can't actually invest with them, but you can invest other dollars if it
Sure.
helps you get to that $1 million threshold.
So it doesn't make
Yeah.
any difference about investing or not. It's just that when you sit down in paper and say, okay, my net
Right.
worth is $1 million.
Do you know how many people that would cut out of the 18% now?
That would take the percentage of households down to about 12%.
Okay.
And that's attractive to the side of the government that's concerned on investor protection.
Mm.
And it really doesn't, it really doesn't stop everyone from, excuse me for that, doesn't stop everyone from investing, but it will reduce the number of people who are qualified.
Right. Yeah. So it sounds like there's several things. The government generally, you're saying, is concerned that there are too many people fitting in the accredited bucket right now.
Yes.
Is that right? And so they're
Well,
looking at ways to reduce the
mhm.
percentage of the population that fall into that bucket. And retirement accounts not counting is one way. Are there others that they're
Well,
contemplating?
the taking the equity from your home, and that's really important. I live on the West Coast, and a
Mhm.
lot of people bought a house for $100,000 in the late '60s, and they still live in it. It's probably worth $3 million today. Free and clear, $3 million. They're accredited. They can fend for themselves, and they're living in that house on their Social Security check.
Sure. Yeah. So
That's
that's why the
trouble.
house isn't included. And
That's
they
trouble. So
decided that
now
in 2008. Yep.
you go to the same thing. We've taken the house out there. Now the people are going to qualify for being accredited with their $1 million in their IRA account, and they're living on Social Security.
Right.
So, they could be renting. Who knows? So I think that's something. And once again, it's a constant battle between asset or capital formation and investor protection.
Right.
Another thing that's along with that right now is you mentioned that today you generally can't invest your money in your 401k into passive real estate LLCs. You can invest your IRA money, not your 401k. And the
Mhm.
problem is, the issue is in the IRA money, you're in charge of your own account. Self-directed IRAs, you're in charge, you make up your mind, you invest what you want. But in the 401k, it's a little different. The company sponsors the 401k, and the company makes a decision of where can you invest. And so we're all like our 401k is invested in a very safe investments, nothing like a hockey team or racehorses or anything like that.
Right.
But Congress is flirting with a bill that would say 401k money could be invested into alternative investments. And one of the hangups is the risk that I would take telling the people in my company that we're going to loosen the reins and let you go out and invest in whatever it is. And if any of those things
Yeah.
go bad, they lose their money in their 401k. What liability do I have
Yeah.
to do due diligence on what I let them invest in? And
Yeah.
I think that's going to come down the line, but I don't know how I'm going to be protected. And I don't know if I'm not protected, I'm not going to let my people do that.
I mean, it's interesting, right? Because, well, one, it seems to be almost this scenario where if both these things happen, the retirement dollars won't be included in the accreditation calculation, but you can then actually invest those retirement
Right.
dollars into alternative investments if both these things were to happen. But to your point on, I mean, everybody has different beliefs, but and I guess the idea is, I mean, the government wants to protect people, right? And I guess there's this feeling that employers should also be required to protect their employees. But I mean, in my mind, it seems like why should any employer be responsible for the investment decisions that their employees make? I mean, that's not a part of their obligation to their employees, I wouldn't
Well, no,
think.
but that's the difference between allowing your employees to have a 401k or letting them go in a self-directed IRA where they truly can make the decisions. So there
Mhm.
is some liability. So I just know that's going to be an issue. But
Yeah,
gee, if
it's
all the
interesting.
401k money all of a sudden could be turned loose to investments,
And that's a massive bucket, I imagine.
very massive bucket, right? And then another thing that's happening is that Congress, the lower house of Congress, has passed a bill that would require the SEC to develop a test, and investors can take the test to
Mhm.
determine if they're accredited, regardless of their net worth and their earnings. So,
Yeah.
okay, so what I've heard on the positive side of that is that would get more people accredited.
Mhm.
That would allow people like you to go out and find accredited people more easily to invest in your deal. However, no agency wants to write that test. The SEC doesn't want to write the test. FINRA doesn't want to write the test. No one wants to administer the test. No one wants to grade the test. No one wants to do that. And one of the things they've talked about, okay, what test would we write that would, by passing the test, would tell us that the person is sophisticated to invest in multifamily syndications, or the person
Right.
is sophisticated to invest in oil and gas, or the person is sophisticated to do um, businesses. What type of questions
It's all different, right? They're all different,
all
yeah.
different? How are you going to do that?
Yeah,
And are they just going to write tests about the securities law as well? I'm not sure that's the major issue.
yeah.
I think the
I mean, there's
asset.
probably a general, like, underlying, do you understand what certain return metrics mean, right? Do you understand, like, trying to get at the fact that do you understand risk versus reward, right?
Mhm.
And you understand I mean, there's probably some general topics that kinda underlie all investments, but, yeah, I could see how that would be difficult. So how does that play out? So Congress has said you have to do a test,
You
but
have to do
everyone's
it.
saying, "Well, I don't wanna do it." How do you think is there a path forward?
Well, it hasn't gone to the Senate yet, and the Senate may very well
Okay,
decide that it's based on the recommendation of the SEC that that's not a good idea. I mean, they
understood.
already have said that if you take a Series
Yeah,
65 test or Series 7, you would be considered accredited. But the problem there is you work for a broker, a securities broker.
right.
You don't want to add that to what you do in your daily life and what the supervision of you would be if you're a registered rep. And
Yeah,
who's going to go out and, I mean, a registered rep is a great idea if you're going to go out and raise money from other people and get paid for it. That's what
yeah,
registered reps do, but not necessarily just to be accredited. So I think they've got something to go on that. But just this week, I was involved in I listened to, if you would, an SEC conference on the issue of finders. Now, a
yeah,
finder would be me coming to you, Kent, and saying, I've got some investors who would like to invest in your next deal. I can look at the deal, get some idea about it, share it with my investors, and if they're interested, introduce them to you, and then I'd like to get paid. But I'm not a securities broker. I'm not a securities broker, so how can I do that? Well, in the first Trump administration, he put out a proposal to allow something like finders to go forward. Actually, the only real rule on finders is a case by a no action letter from a singer called Paul Anka. If you've ever heard him, it's probably before
yeah,
your time. Paul Anka was a fan, I think, of the Winnipeg hockey team, and they wanted to build a new stadium and raise some money. And so he wanted to tell the people at the hockey team about all of the people that he had in his database who would probably love to invest. Well, he's not a stockbroker.
Yeah.
And so they went to the SEC and they wrote a letter and said, if Mr. Anka just simply gives us his database and we go ahead and market to the people and they buy and we don't pay him, will that be okay? And the Paul Anka letter said, yes, for this one thing. He can give his list to the hockey team. They can do it. He's not making any recommendation. He's not doing any due diligence. He's just really introducing you, and he's not getting paid. So that's the only thing that's real today. That's a real no action letter that you can act on, but that's pretty draconian. So what they're trying to do is Trump came along and said, let's change that. Let's let people introduce investors. Why? Capital formation. Let's
Right.
let people new investors to other good deals. And we should maybe set some rules about that. And so they had a 2-tier program that they're talking about. One tier is you could get paid, and another tier is you can't. And when you can get paid, maybe you'll do a little bit more. You do some due diligence on it, on the deal or whatever.
So would this be some sort of license that folks have to get, or just a certain
Question.
criteria they have to
Are you
meet?
gonna be a licensed finder? I don't think so. Well, that proposal in his last term didn't go anywhere.
Okay.
But now the SEC, the Republicans are in charge of the SEC, the 5 directors, and they're bringing that back up. And so last year in April, I was at a live conference where we talked about it. And 2 days ago, I'm at a virtual conference where they talk about it. And they're putting their thoughts together. Their concern is, do we need to license these people? And of course, the broker dealers are saying, no, they can come and get their license with us.
Right.
You need to do that. Okay.
Right. Which people already do, don't they?
People do.
Yeah.
And then the next issue is, well, what if Gene Trowbridge puts together a team, 20 people, and call it the Trowbridge Finders LLC, and we run around and all we do is try to find passives to invest in other people's deals? Well, shouldn't I be regulated on that? Shouldn't there be some rules? How about a track record? Maybe before we let people be finders, we should find out on the deals that they've recommended in the past, how the deals go. How do they know? And so they're wrestling with that.
Hmm. But it sounds like there's a path where this becomes
Yeah.
like a legal option to, I don't know if legal is the right word, but an SEC compliant option to refer people into alternative investments or
Sure,
just
I
any
think
investments.
it would be with a caveat that they're not doing any investment recommendation. They're just saying, hey, call Kent.
Just making introductions.
Yeah,
Gotcha.
he's getting, and
Gotcha.
no payment at
And
all.
no payment. But you said there was a path where there was potentially a payment available.
I don't know about that. The rule is,
Oh, I thought you said there were maybe two paths.
yeah, the first path isn't worth talking about. This is the path that's
Oh,
that's
gotcha.
gonna
So the
maybe
path to
gonna
get
go.
paid is not really on the table. It's more
No,
a
I don't
path
think,
where you're just allowed, you could make an introduction. Gotcha.
because the rule is no transaction based compensation
Right.
can be paid unless you're a broker dealer.
Meaning it can't say like, I'm gonna raise this much money and therefore you're gonna give me X, right? Whether it's dollars
Actually,
or stock or anything.
with a client right now who's putting together their own LLC, and then that LLC is going to invest in someone else's LLC. You might call it a fund. Put together this LLC, it's going to invest in that LLC, and that's all fine because this LLC we're doing would have all their rules and all their compensation and everything. And then when
Yeah.
it becomes an investor in that LLC, it'll just get paid what you get paid as an investor. However, this person has struck a deal with the big fund that based on the number of dollars they bring in from their little fund, they will get a percentage of the general partnership interest. And I'm suggesting that they can't do that because that's
That's
compensation.
not what you can do,
They're
right?
getting compensated in what? In percentage ownership of the general partner for what? For raising money.
Right. Is there any scenario or structure where that does work? If you were having a fund invest into another fund and they're getting they're getting
Sure.
paid in some way or
Sure, not for raising money.
okay.
Maybe they can get paid for property management, or maybe they're a contractor, a developer, or
Gotcha. Okay.
something like that, but not for raising money. We have to be very, very, very
Yeah.
careful on. So those are the things that are happening, and it's all interesting. Over the years, the issue of too many accredited investors has been on the SEC's mind. There's
Is this
always some talk about it.
so yeah, it seems like something that's been an ongoing conversation for quite some time. Even you said there were changes in 2008 with Dodd-Frank and
Mhm.
things. Is it something that's coming to a head now or something that's just kind of
Oh,
always a
no.
conversation?
I thought it was coming to a head 2 years ago, but it hasn't come to a head. One of the issues that they have, they keep falling back on, well, why don't we just apply inflation to the million, the 200 and the $300,000 and bring it up to today? In
Sure.
1980, $1 million was a lot of money, but that everything would be tripled. The net worth would be 3 million
Yeah.
without your principal residence. The income as an individual taxpayer would be 600, and as a family, it would be uh, 900,000.
Yeah.
That
So
would be the easiest thing, and no one would argue about that, except for all the stockbrokers who are raising money. See, most of the money in our business isn't raised by you and me as syndicators. It's raised by the stock brokerage firm. And if
right.
all of a sudden all their people in their Rolodex had to have $3 million net worth and whatever. Although, so you're not accredited. You invest as an unaccredited investor in a 506B, right? You can take 35 non-accredited investors. You can go to Reg A and take all the non-accredited investors you want.
So do you think I guess the case of that, I mean, the stockbrokers aside, the concern of going 3x on everything, is it because it would actually lower the percentage too much? Gotcha. So then
Well,
the pool
that's what the
would
people
be
who want to raise, that's what the Kent Ritters who are raising money are going to say, oh my gosh, that's
well,
going to
yeah,
cut maybe.
understood, right? It just brings it down too much. I just didn't know what percentage of people, that takes out of the picture. I imagine it's quite a few going from 1 million to
I will,
3 million on your net worth. And
so
then
we'll see, but that's what's happening in business.
so if this does play like let's say they do that though, and to your point, there are what's the right term? Other structures, other regulations that you can raise money under. You could do a Reg A, like you said, or B.
Or you can go public.
So do you think I mean, because people are going to find a way to invest and people are going to find a way to raise money. Do you think it just changes? Like people aren't doing these Reg D deals and it just changes to another deal structure type that would allow for non-accredited investors is
Sure.
probably the shift?
Regulation A, Grant Cardone,
Right.
Regulation A plus can raise 75 million a year with as many accredited or as many unaccredited investors as you have. There are some limits to how much an unaccredited investor can
Yeah.
invest, maybe 10% of their net worth or whatever. But that's a 6-month process and $100,000 in cost to do a Reg A offering.
So you've got to have a
That's
big fund.
fit
You've
for
got to have
real estate.
something that's going to live for a long time and be wanting to raise $75 million, right? So you got to
Mhm.
have a big deal or a big
Well,
fund.
actually, Reg D, 506B and 506C, there's no limit. Last year, we did a $158 million raise in a 506B in 30
Interesting.
days, 30 days, all from family
I was gonna
offices,
say somebody had a bunch of rich friends or family
all from family
because
offices.
that's the requirement, right? You have to have a pre-existing relationship in
Right.
that under a B model. You can't just find people on the street.
In the
Yeah.
C model, you can advertise, you don't have to have that relationship.
Right, and that's how we do most of our deals right now
You
is
didn't see? Well, then you have a track record.
yeah.
When you tell me that, then I know you have a track record. Putting an ad out there and asking me to send you $50,000 to invest when you don't have a track record is not effective marketing.
Yeah. Well, it used to be. It used to be. It's not so much anymore, it seems. I mean, I know a lot of groups that raised a lot of money doing that back a couple years ago when everybody was doing such things. But yeah, it never seemed to me something that I would personally do if I found an ad on Facebook and want to give them $100,000. But
That's why
yeah,
you need that's why you need to develop your track record, and
Yeah.
people who are investing. I think the investors who are listening, I, I, I'm going to say something I'm sure I said the last time. What I think an investor should look at is, first of all, what's the continuity plan? If Kent was coming out with a syndication and he individually was going to be the managing member, I wouldn't invest because we've been through COVID. We've been through all sorts of things. The managing member becomes incapable
Mm,
for me.
yeah.
So we got to have continuity. I mean, I have partners. So if you hired me to do your operating agreements and everything, I better have someone to take over in case I get
Right.
sick or whatever. So the
Yeah.
first thing you need is continuity. The second thing you need to do is you need to ask the syndicator, have you done this before?
Hmm.
And we all started out, Kent, you and I both started out. No, I've never done this before. This is my first deal. Okay. So what else was there about you that attracted your investors in your first deal? What else was there about me
Yeah.
that attracted investors in my first deal? And then you start building the track record.
That's right.
Then I think the third thing it should say is I should ask you, Kent, are you going to have any skin in the game?
Hmm.
Put some of your own money in the game. You don't need to be the biggest investor. You don't even do, let's say your offering is 100,000 minimum. I don't even think the sponsor has to put 100 in, but we have to have some
Sure.
skin in the game. And then the
Yeah.
fourth question is, what about liquidity? If I'm in your deal, what are the plans in case I need my money back? And to that, you would say, well, our operating agreement has 3 or 4 liquidity provisions. I'd be glad to share them with you. So those are
Hmm.
the 4 things I think you should ask. I haven't asked anything about the property yet.
Yeah. I think those are great questions. Those are questions that most people probably wouldn't lead with. And so appreciate you sharing those today.
Because, one of the things I did when I started and I learned is I thought if I had a PPM, good, I've got a PPM. Now I can go ask anyone I want if they want to invest with me.
Yep.
And I learned very carefully that if I'm offering people a chance to invest in an apartment building and all they do is blockchain, I'm wasting my time.
Yeah, that's right.
So I said, gee, that's great. I've got all this done, but I'm starting with just such a target market. Will you buy my deal? So
Hmm.
I turned it around and said, I'm going to build my database on people who, and I call it sell the sizzle. I'm going to sell the sizzle of investing in real estate. If they don't want to invest in real estate, good, let them go somewhere else. But there's plenty of reasons to invest in real estate. Number 2,
Absolutely.
sell the sizzle of the part of the real estate industry that you've settled on,
Hmm.
that you can do well and you see opportunities.
That's right.
Number 3, sell the sizzle of your team. Okay, you got a bunch of people who want to do real estate. They want to do your part of real estate, which is in the multifamily business. Now, who is my team? Because I told you of all these opportunities and these benefits. How are we going to make that happen? How are we going to realize it? Well, you have to have a team. And then the last thing you do, which is pretty easy, because now you've got nothing but people who want real estate, want multifamily, and love your team, ask them if they'd like to invest.
Yeah, absolutely.
But you've gone a long way down there before you get that question. Before that, I started with that question.
Yep.
Do you want to
Yeah.
invest? Well, who are you? Have you done it before and all that stuff?
Yeah, I mean, I think it's a great piece of advice. I mean, old sales training that I had taken years ago. I mean, we call that like meeting the buyer where they were, right? Where they were on the journey. Do they know about real estate? Do they like real estate? Okay? They like real estate,
Mhm.
but they've never done multifamily, right? Understanding where they are to be able to meet them where they're at and answer the right questions. And so, yeah, I think that's well said, Gene. Thanks for sharing that as well. Well, I mean, it's been a great conversation today. I appreciate the insight into. It sounds like we don't know which way it's going. Accreditation sounds like it's probably changing. It's either becoming more restrictive or expanded, or maybe one in one way and one in the other with a test. But it's difficult to say. We'll have to keep an eye on the news and what Congress and the SEC are doing. It sounds like. But it sounds like there is, this idea that there's gonna be some change
I would
happening.
bet on it. I
Yeah.
would bet on something because,
Mm.
but one of the things that's happened is 2 years ago, the private placement market was $4 trillion. Not all real estate, of course, but securities offerings that didn't need to go to the SEC. Last year, it was only $3 trillion. Market slowed down.
Mhm.
There's a lot of money out there. And maybe they don't think at this level of investment, they need to be all worried about it because it's slowed down. Maybe. But I think things are going to pick up. I think there's going to be a lot of money in the marketplace looking for something to invest in. And
Yeah.
if this heats up a little bit, who knows what they're going to do. But it's a great business. When I was a syndicator for 20 years, all sorts of things happened. And then
Yeah.
I became an attorney, and it's still the same. The things that I know about being a syndicator, like you, Kent, is number one, the care and maintenance of partners can become overwhelming. When I left the business, we had about 850 investors, and I
Wow.
sent out about 1,700 K1s the last year. And that's overwhelming then. But what about now? What if I still had those 16 funds going and there's no money raising? I still have all those investors to take care of. So
Yeah.
that's a challenge. And the second thing I think syndicators learn pretty quickly is there's always more risk than you think. When we were writing documents in the 2017, 2018, we never put in the documents that there was a fear of a pandemic that was going to affect multifamily business. If you
Yeah.
couldn't get in the units, the government say that people don't have to pay the rents. We didn't know about that.
Right.
So good. Now we can put in the document that who knows, maybe there'll be a pandemic. But then in 2020 and 21, what we didn't know is that the Federal Reserve was going to raise interest rates 18 times. And everyone with a 5-year bridge loan was going to be in trouble. I've heard people today say, Kent, that every apartment deal that was done in 22 and 23 is in trouble, just
Uh,
across the board. I don't know.
Yeah, I mean, it's very yes, if you've done variable rate debt and you're in the wrong market,
Mhm.
absolutely, right? Because we've got deals in those times that are just fine, but a lot of ours are in the Midwest and in a, you know, different interest rate environment. So it depends. But yeah, I mean, absolutely, there's a lot of deals that have gone sideways, um, because people got too aggressive on debt and over levered, and yeah, who knew interest rates could do what they do? I think
And
the
a
good
lot,
news is now it's on
lot
the forefront
a
of
lot
people's
of
mind.
investors are counting on disposition of property so they can get some money back so they can go out and invest again. But
Yeah.
sales are sure slow. So
Yep.
thanks for having me, Ken.
Absolutely, Gene. Thanks for coming on. If folks wanna reach out to you, how can they reach you, or where should they go?
Okay, well, my email is pretty simple, Gene, Gene at TNLLP.com. That's Trowbridge, nay, LLP.com. So that would be the best way. Just reach out there or go to that website. And if you want to talk, I'd love to just talk with you. Consultations are free. You can sign up for a consultation there. And if you go to the website, another thing you can do is you can get a copy of my brand new book, just out this month,
Yeah.
the fifth edition of It's a Whole New Business. So that's out, and you can get one of those from our website, or at least just get a free PDF of the book if that's the way you want to read.
A whole new business. I love it, and we'll make sure all that's listed below so folks can click on the links and get access to those things, and Gene, thanks for so much for coming on and sharing your knowledge with us, and I hope you have a great rest of the day.
You too, Ken. Thank you.
Thanks.